Welcome back to Lamb's Cryptoverse. Well, today is a very important day. This is the most important day of the Fed regime change that started way back earlier in the year. What happened today is very crucial. It's that the ISM PMI index finally started declining. It's still at a somewhat high level, but this is it. Today was the tipping point, October 3rd. I anticipated this would happen maybe a few weeks or a few months too early. So I was over anxious, anticipating that the ISM would decline more like in July instead of what it did in August and September. And I was anticipating rates to decline sooner than they happened to be declining. And the reason I was incorrect, or too early, I should say, or both, is because number one, inflation has been stubborn, and two, there's been a lot of wage inflation, and wages have been a real sticking point, no pun intended, on inflation. So the Fed has to be more hawkish. And we saw that back in the 70s when inflation was higher, when the ISM declined. You didn't see a quick decline in interest rates until a few months later. So there was more of a lag. And you can see this if you go down there and look at my previous video. I just did a video prior to the ISM index coming out. I predicted that the ISM PMI index would finally decline and that rates would decline, but there might be a lag. And I showed old data going back to the 70s and in the previous recessions of 2001, 2002, and the great financial crisis. So you can take a look at that video. So what I want to talk to you about today is that why this ISM index is so crucial and what it means. So this ISM tipping point where it's declining now instead of rising, it's very crucial because we've reached phase two of the economic decline, but also the stock market decline. Phase one of the stock market decline was the compression of the PE ratio. I like to look at Ed Yardeni's data. He's got great data on the PE ratios, and I'm going to be going off screen, and I'm going to show you all these charts. But basically, I think everybody knows that PE ratio was way too high, something like in the 20s, and it's declined to 15. I think it could go lower to the previous levels that it was in the mid 2000s, to maybe from 15 down to 12. But that's not what I'm looking for in phase two, actually. There'll be some of that PE compression, bringing down the S&P 500. But what I think we're going to have is the decline in E in the PE ratio. You're going to see earnings estimates get slashed. And let's go to the charts now. And we're going to start looking at Ed Yardeni's great charts. The first one is this. This is a forward PE ratio, and you can see, like I said, it hit a high of like almost 27 for the small cap, and the large cap hit high 22. This is on a weekly basis. And as you can see, this could go way down to 12. And it was much lower back in the 70s and 80s when interest rates were high. Because there's a theory that when interest rates are high, the PE ratio could be much lower. And I do believe in some of that theory. And this is a forward PE ratio. If you're looking at the daily rate, and you can see it's come down quickly on S&P 500. It's down to 16, but again, it could go down, according to this chart, it could go down to 11, but like I said, it could go even lower if you're adjusting this for higher interest rates. And we saw that again, we saw that back in the late 70s, early 80s. So when the ISM came out, and I'm going to show you the ISM, I actually have it here. I printed it out. The index went down to 50.9, and that's down from 52.8, and it was lower than expected. And what's really important here, the only thing you need to look at is right here. I've got to highlight it. New orders index returned to contraction territory of 47. That's a 4.2 percentage points lower than it was just a month before, 51.3. And they break it up down over here. You can see new orders, it's a little blurry, but you can see 47.1 versus 51.3. That's pretty bad. And then what I always like to do is look at the commentary. Where is that? Well, I'm not going to read it to you, but basically the commentaries are starting to show that there's some weakening, but it's isolated. It's like this first comment says, there are supply chain issues for all electronic components. So there's still some tightness of supply when it comes to electronics. This comment says business continues to be strong. But, and you can see, however, for this next one here, business is strong. However, people are worried about the rest of 2022. And that's right here. So in some ways, the commentary is still at a tipping point. But the new orders is saying that we're contracting rapidly. And I tend to believe that because the problem is, let me talk to you directly here. The problem is, in my view, is that there've been double and triple ordering. You see, in some industries, you don't get slashing, you don't get hurt, you don't get fees if you cancel your orders. You don't get cancellation fees. So what do companies do? They order from one chip company and then another chip company, even though they only need, 10 million units of chips, or whatever it is, 10,000 units of chips. They order 10,000 from company A, 10,000 from company B, and 10,000 from company C, and then they'll cancel orders with no fee, no cancellation fee. So let's go back to the videotape here. So because the ISM index was weak, what we had here was a very strong showing in equity markets. That's what I said could happen because the equity market is looking for a pivot in the Fed raising rates because now the economy looks like it's going to slow. I don't think that's going to happen because the unemployment rate is still too low and the labor market is still too strong. So beware. But what I think could last is this. You're seeing bond prices go up because rates are going down. So I think the best place to play this in part two of the decline in the stock market is actually by buying treasuries. So I'm still going to watch this. We may not be there yet because the problem is overseas. If rates are going up overseas, it's going to affect our rates. So just be careful here. See what's going on in the UK and in Europe to see where rates are going. So if Europe is fast going into recession, again, if Europe goes into recession, that's going to compress rates. And if rates are compressing overseas, they're going to go down here. So I think what you could do is short the U.S. market in terms of equities or buy long treasuries, but just watch those rates overseas. I wanted to talk to you about a few more things. Oh yeah, that's with this here. I think stocks go up temporarily because of, let me go show you this first. There's a lot of buildup and a lot of bears. We've got a huge number of bears, 60.8% bears. This is from AAII research. And thanks to Ed Yardani, he posted this. And you can see we have the highest number of bears since the financial crisis. So that means that stocks could go up short term. But I think this is only a short term thing because earnings reports are coming out. As I said, the economy is weakening and you're going to get cuts to earnings estimates. But short term, maybe stocks could rally. But I feel safer buying treasuries. And I want to show you one last thing. Another reason I'm not bullish in equities, at least over the next few weeks, like after we get this short-term rally, is we still see equity investors buying mutual funds and ETFs. There's still some inflows. So there's a lot of, as you can hear from me, there's a lot of cross-current of data. You got bearishness in retail investors, but then you got investors buying equity ETFs. Like, which one is it? Are you bullish or bearish? So there's a lot of cross currents. So I feel safer buying treasuries at this point in time. But what I wanted to tell you, the whole point of this this video conference was to tell you that this weakening in an ISM PMI index means that we're going to phase two. Whether or not stocks are up today, tomorrow, or next week means nothing, because once stocks go up a little bit, they're going to start crashing again. And I think the S&P, and let me show you a chart of S&P. We're at 3,700. And even though that we're down a lot, I think we're down 25% from the high, I think we can go down maybe below 2,800. If you look here, there was a lot of support at 2,800. So that's what I'm looking to go, to 2,800 on S&P. So here's how we can play this. I think we can go up short-term and equities, but then because of the earnings compression, we're going to go down, I guess in maybe October, November, December, depending how earnings reports are. We're going to go down, and I think the bottom's going to be around 2,800 in S&P. So it's going to be a rocky ride. So again, I think your safest bet is to be long treasuries. I'm not sure if it's long-term treasuries or short-term treasuries, because we need to see what's going on in Europe. But just be safe out there. Thank you. Bye-bye.